Hi there, thanks for joining us here at PhillipCapital Market Watch. I'm Jin Ru, Business Development Executive from Phillip Futures. Today we'll be talking about whether we should worry about a yield curve inversion. First, some basics. A normal yield curve is concave upwards. This is because the longer the term to maturity, the larger the risk undertaken. Investors demand a higher yield for undertaking this risk. However, under special circumstances, the yield curve is inverted. Investors start getting worried as the inversion is viewed as an indicator of a weakening economy and is believed to predict a nearing recession. The 3-month Treasury Yield exceeded the 10-year Treasury Yield recently on 22nd March 2019. This caused widespread panic among investors and prompted some of them to start offloading their portfolios. But is there truly a cause for panic? And does the yield curve inversion really imply a future recession? Empirical evidence shows a strong correlation between the yield curve inversion and a recession. We believe that the yield curve inversion happened as a result of market-moving events and should not be seen as a predictor of a recession. The US Federal Reserve hiked interest rates 4 times last year due to strong economic data and fears of rising inflation. Continuous hikes led to a strong dollar amidst trade tensions between the US and China and a global economic slowdown. Pessimism surrounding the slowdown and the continuous rate hikes have caused short-term rates to soar and long-term rates to fall. With trade tensions easing, better than expected economic data from China recently, and strong corporate earnings, economists and analysts have said there is little reason to panic over the yield curve inversion. But until the crosswinds die down, we should remain cautious. To conclude, it is too early to panic over the yield curve inversion. However, it isn't something we should ignore as it reflects the market sentiments of investors. Fears over a recession subsided shortly after the yield curve inversion as investors realized that it was not caused by weak economic fundamentals. Instead, other indicators like GDP growth, unemployment, manufacturing data, inflation, retail sales, and corporate earnings should be monitored as predictors of an economic downturn. That's all for PhillipCapital's Market Watch. Do remember to follow us on social media and subscribe to our YouTube channel. Also tell us what you think. What are the signs to watch out for a recession? Leave your comments. Thanks for joining us and see you soon.